Good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to Trading Coach's Playbook. This is Brandon Wendell with you live and live on YouTube as well. So welcome everybody who's watching there. Hold on for just a second. Sorry. Dogs are running around behind me. My wife is texting me always at the right time. Let me tell you. Just bear with me for just a second. Okay, so before we get started, I just need to put out a little disclaimer here. Hopefully you guys can see my screen and hear me. Excuse me. I just need to remind everybody that we are not registered broker-dealers or investment advisors. I am not giving out recommendations, excuse me, or trading picks. I'm basically looking at the markets for educational purposes only. And anything I talk about is not a recommendation to buy, sell, or hold any security. Also, all trading does involve risk of loss. We're going to try to work on reducing the risk, but you can never eliminate it. And free management partners or personnel are not subject to trading restrictions. I can have a position in a security, initiate one at any time. So with that being said, again, welcome. And I'm going to talk a bit about spread trading, what we can do to both reduce risk and increase probability when it comes to our trading in the markets. And we can even eliminate or minimize directional risk. So when it comes to trading in the markets, I'm going to take this out actually to a bigger time frame. We'll go to a daily chart here on crude oil. And I'll leave the RSI there, it's fine. But basically what happens when it comes to trading is we normally would get in, I'm not wearing the bow tie, decided to be casual today. I got to go do some grocery shopping later. And anyway, I'm being lazy. Let's put it that way. It's looking like it's going to pour out. We keep having lightning strikes and the thunder rolling in the background here, but it's my casual day. Anyway. So getting back to this, like I said, what happens in the markets is that typically when we're trading, we're looking for a directional bias. If we think things are going to go up, we're going to buy and go long. If we think things are going down, we would obviously sell and go short. But there's another way of trading in the markets, one that reduces risk because it doesn't matter whether the markets go up or down. We're actually trying to make profits on a relationship between two securities rather than the direction of the two securities themselves. And that's what's called spread trading. Now, most people, when they hear spreads, think immediately about options. And that's not what we're dealing with here. We're not dealing with options. We're not even going to look at options. We don't need to. We're simply going to do this with the futures market. So when we look at this, for instance, crude oil, I'm looking at, this is a continuous contract. Let me look at the exact contract we're trading right now, which is the December 2021 contract. And I'm going to change this to a line chart so we can see. There it is. Perfect. I don't know if I can thicken that at all. I think, yes, I can. There we go. Perfect. And now what I can do is, remember, when you're trading crude oil, obviously, again, we can either try to buy or we can try to sell and profit from upward moves or downward moves. But there's other contracts trading. It's not just this one that's available. You can go all the way out, honestly, to, let's see, CME group here. Probably 2025, if you want to go far enough out. Now, the only problem is the further out you go, the less volume you're likely going to find. So if we look, for instance, here at West Texas Intermediate Crude, we can go to quotes. Let's see, my dog's barking at the ducks outside. Anyway, you can see that the December contract right now, they're trading 306,000 contracts so far for today. January still has volume, 86,000 contracts, but it's a lot lighter. And I wasn't kidding. You can literally go out 2023. If I load all, it'll go out to, I think, 2027 or 28 possibly. So you can go out quite a while for that time if you need to, but there's really no need. We typically want to trade what's called the front month. And that front month is the one with the most volume. You can see December 2022 actually has a lot of volume, 32,000 contracts just today. So why would we look at these other contracts? Well, if I bring in, let's just do the next contract. The next one is going to be CLF 2022. So I'll bring that one in and you'll notice, if I thicken the line on it a little bit, whoops, didn't work. That's the one I needed. There you go. What you'll notice is while they do trade very similar to each other, they don't trade exactly the same. As a matter of fact, this big run-up that we've had since 6th of October, you notice the front month, which is, again, in the blue, I might as well label what they are. In the blue, we have December oil. And in the yellow, we have the January oil. So what we're looking at here is that the December contract moved up further and faster than the January oil did. Now, the reason why it did this is very simple. Take a look at the volume being traded. You can see here on the quotes. For instance, today, the daily change is 19 cents on December, but 14 cents on January. Why? Because there's more volume and therefore more price movement typically. You can see that on the February contract, it only moved up 2 cents today, even though there's still some decent volume. March even went down again, even though there was high volume, high enough to be able to trade it. So what a spread is nothing more than the price, the physical price difference between those two contracts. And you can see that that difference can fluctuate. Sometimes it's very wide and other times it's very narrow. But typically what will happen is when prices move, let's say in an upward direction like this, and let's go a little more dramatic. Let's go to that. Let's see what other one had high volume. There was a spike right there, March of 2022. So let's change this instead of the January contract. Let's try the March contract and see if it's a little more dramatic. There we go. Yeah, and it definitely is. Look at that. Sorry, my dog is going ballistic. Hang on. Had to go yell at her. She's standing out of the rain yelling at about, there's probably about 30 ducks out there right now. Where I live on a little river, and there's obviously a lot of ducks that live there. We kind of adopted them. We started off trying to rescue a couple of the babies. They fell into some of the storm drains and had to pull them out and reunite them with their moms. So we ended up feeding them, and now they all come by every day, twice a day to get fed. So they became our adopted ducks, and they let us play with them, and the ducks play with them too, or the dogs play with them too. Anyway, so here we have a little bit more dramatic move, where again, you can see the March contract is moving up much faster than the December contract is, right? Well, the December contract should be worth more theoretically, right? You would think that. That's a great question, Joseph, because you have what's called fair value on the contracts. That's why they're not all priced the same, right? When you look at the different contracts, you can see that we have different prices for each of these. And normally the back months would be priced higher. That is called contango. Oops, let me do it here. So in a normal market situation, time is worth money. It's got a value to it, right? So the contango, the front month is cheapest and back more expensive. So that is the typical situation for most commodity futures. However, what we are seeing right now is a different situation called backwardation. And that is when the front month is cheapest. No, the other way around. Front month is expensive. And back months are cheaper. So that's called backwardation. And that's what we're seeing right now. The dog's not that loud. Oh, yeah, that's good. Yeah, she stopped barking anyway. So I'll ignore her. I should put him upstairs. But anyway, backwardation is what we're seeing right now. Normal securities, you would see the further months out have a higher value because there's more time left until the expiration of the contract. So time is money, so to speak. However, we are in what's called backwardation right now in a lot of contracts, and it has to do with the interest rates. I don't want to go too much into it, but I do talk about it a bit in my E-Money Think Tank program. But in the wealth with spreads, which I'm going to talk a little bit more about, we're actually just concerned about the price difference between these two and taking advantage of that. So the spread is the price difference between two contracts. And it gets wider and narrower. It changes, as you can see here. So when the prices are going up, typically the front month, because of the higher volume, will move up faster than the back month. So what we can actually do is take advantage of this. And the way you take advantage of that is if you expect prices to go up, let's see, I want to bring up a different chart here that's not, yeah, there we go. We'll do this. So CLZ 2021. That's my daily chart I'm bringing up here. And let's see, we'll maximize that for a moment. So hypothetically, if we can refine an opportunity where we want to buy, and let's go back in time where prices had actually rallied. So right here in the previous months, actually I probably have to do a different contract for this, to be honest with you, but you can see the December contract bounced right here in August. Now, we weren't trading that in August, really. You could have, but the August contract, I'm sorry, back in August 20th, the front month contract was probably September or actually October. We were probably trading the October contract at that time. Okay, so again, going back in time, that would have been the front month. And you're looking at the bottoming out right there on the 23rd as we came into a demand zone. So let's say we come into the demand zone. We actually entered it here on the 19th. And as I mentioned, we really would have been trading the October contract as the front month at that time. So once again, going into August, there it is. Same level on that time. I must have drawn this when it was there. But you can see on that date, August 19th, this is the October contract now. It came into an area of demand. So I have a choice when it comes to this demand zone. I can go ahead and simply buy that contract. Actually, let me do one more thing here while I'm thinking of it. I'm going to open up this Trade Pro Trinity demo because it's going to help me with the margins. So let's say we were back in August of this year, and we saw that there was not only a demand zone, but we identified this area as supply. So we were going to buy, this trade was going to be setting up for a long opportunity at 62.92. Oops, remind me later. With a stop loss at, I can type today, let's say 60.65, just below the zone. And the target, so the target came up here. Was going to be at, we'll say 72 even. There we go. So we have a risk right now of, let's see, it's a little under 30 cents. So we have, let's see, 16.92 be 30. So 3 off of that. So we're looking at 27 cents risk or $270 risk in this position. Okay, so that's what we're looking at right there. $270 risk. Sorry. And the reward, let's see, we have 72 from 62.92. So we're looking at $10.08. There we are. Nope, sorry, it's 1,080. That's a reward, 1,080 for that trade. Pretty good opportunity. Oh no, I'm sorry, that's $10. That's 10,800. 10,000, my bad. I almost ripped this off there. $10 move. So it's a really good trade opportunity. And obviously we see it worked. That's where we ran to, and that's where we just turned down from recently on our supply. So the daily trade would have been getting in on August 19th and then exiting. Let's see, we have the exit date here, hitting the target on September 15th. So again, let me just set this up for us as a scenario. I think it was 15th. Now, the margin, or what you have to come up with for this trade is, let's see, if we go trading margin calculator, it's nice because it works really well on this platform. If I go into CL, and I have to use the current contract now, so we'll do Z, and actually, I'm sorry, it's GCLZ on this platform. There we go. When I calculate the margin, you can see it's $5,610 for the initial risk. That's the margin requirement. So in order to get into that trade, we had to come up with $5,610. Which means that our reward was pretty good. It was about 200% rate of return, right? We're making 10,000 $80 divided by 5610, the margin, and it's 179, we'll call it 180% rate of return. There you go. So that's this trade. And as you can see, it was very successful. But there's other things that we can do, and we can protect ourselves. There are times where you see prices moved up, missed our target, it went to $70.59 and pulled back before continuing higher. So if we wanted to protect ourselves a little bit and reduce our cost basis, we would create a spread trade. And the spread trade, I'll go ahead and put that over here in the separate chart. What we're going to be doing is literally trading two contracts against each other. So I mentioned the first contract was the CLV for October. And then our second contract that we trade, we can choose perhaps the December or even the January contract, whichever one we want. I'll do the CLZ 21 first, see how that looks. It wasn't much of a difference there, but we could possibly go with the January 22. You usually want to do a few months. So we go to CLF 2022, and we'll see. Actually, the way I can do it was this, minus CLF 2022. There we go. And also have the other chart on, do I? I do. I got to get rid of that other chart. Bear with me for one moment. So I remember how to reduce that. There we are. And this one wasn't really that much of a profit. Again, let me go back and see if maybe the Z contract was better. And this is a trick. There's other things you can do to pick out which contract to be trading. 15th. It wasn't the best. Honestly, this trade didn't work out that great. Let me try. There we go. We'll try this one. So this is a spread. And what I did now is, again, we're going to use the August contract. I'm sorry, October contract, but this time I did the February contract. So we did separation about 4 months there, 5 months. And we're going to look for the same date, August 15th for the entry. Or sorry, 19th. There's the 19th right there. So the entry in this case, now what we're charting, by the way, do I use the RSI at the entry or just the demand zone? I actually would use the RSI at the entry too. Yeah. And what I need to do here is, oops, not that. My settings. There it is. It's hard to see the font on the right-hand side. I was going to try to pick that up to a bigger size, and I forgot to do it now. Let's try this. There it is. Much better. Okay. So basically what's going to happen now in this case is the chart I have is CLV 2021 minus CLG 2022. So what we're viewing is the price chart is the price of the October contract minus the price of the February contract of the next year. So the price you're seeing, the number on the side here, the $1.49, that's the price difference between the two contracts. That's all it is. So if we were looking at this here, the December contract right now is 82.69. And if we looked at the February here, 80.15, the difference would be, what is that? 45 cents, 44 cents. No, 54 cents. My bad. So 54 cents is the difference there. That's the spread. That's what it would show right now if I charted those two. So that's all I'm looking at is the price difference between these two. So now our entry is going to be the closing price on this day, which happens to be 144. I'll put that in. Come on. 144 on that date. So it is still a long entry. And what I can also do is still identify a supply zone and possible stops. So we have a possible supply zone here. And obviously I can also chart this with candlestick charts, but often you don't get very good charting when it comes to some of the intra-market spread. So I end up using line charts to get a little bit clarity here. So we've got a supply zone, a possible target at 297. And what I can also do is place a protective stop loss below no greater than 1/3 of my potential profit. So if I wanted to, I can also put in right now a stop, let's say at 120. That means I'm risking 24 cents or $240. My target in this case would be 297. Okay. So I'm not going to make as much dollar wise potentially, but you're going to see why I'd want to do this. Now, the RSI can definitely help me when I'm getting into my trades as well. What we're seeing in this one as I pull forward a little bit is, might have been stopped out there too. You can see we had a positive divergence. What I mean by that is you got prices making lower lows, but the indicator is making the same lows. That's a bullish signal. So it's unfortunate this one would have stopped out. So I don't have a good example here, unfortunately, but that's the way it goes. Sometimes you get stopped out. If I wanted to make sure that I don't get stopped out, I can put in my stop at least one ATR beyond, or at least maybe a third of my potential gain. So my potential gain, which happens to be 2.97 minus 1.45, it's $1.52. So the reward is 1.52 or $1,520. Is that right? Yeah, $1,000 for point. Now, that's the reward. The risk, again, I can decide to do 50 cents. So I can put in my risk instead of stopping at 120. So 94. That's right, isn't it? I don't have to take that much of a risk, but we can. Minus 0.5. Yeah, it's 94 cents. So I have $940 of risk. That's one, no, that's not 1/3, is it? Wait a minute. What did I do wrong here? That's why 144 for 152 for our target. I was using the wrong number. Divided by 3. The stop, yeah, 50 cents. So my stop should be 50 cents below. And my risk is $500. Excuse me. That's what I was doing wrong. I'll wake up today. Don't worry. It's the rain. It always makes me feel kind of weird. Kind of out of it. It's pouring now. So anyway, I put the stop there at 94. We got risk of $500. Here's the key thing though. When I go to take this trade, I don't know if you can hear that thunder. Now we go into that crude oil. And again, I can use that December contract and I'm going to go out and use GCL instead of February. I'm going to try to keep the same number of months here. So we had October and February. So you got October, November, December, January, February. So instead we'll do December, January, February, March, April. So I'll use the J contract, CLJ22. And we're going to short one and buy the other. And now look at my risk, $1,265 for the margin. So instead of having to come up with, I don't remember what it was, $5,600. Remember for the margin, we cut our margin down to a measly 1,500. What did I say it was? Oh, sorry, 1,265. That's one of the key things when it comes to trading these futures. Your margins are reduced dramatically. So we can compare the two where we have, I'll have to look at the rewards and risk as well. But you can see right here, we had that move up and I was using $5,600 to take a trade there. Or I can go in with $1,200 of risk. And once again, I'm still making a potentially good rate of return. 1520 divided by 1265 is a rate of return of 120%. So rate of return isn't quite as high, but the costs are also much reduced. And so can be the risk. This case, not necessarily, but a lot of times it is. So We take a look at what happened here. Unfortunately, it never got up to that target. You can see by September 15th, there was a profit. It just wasn't as much. So unfortunately, we only moved up to about 192. So it still made a good 50 cents or $500 to the upside. So rate of return wasn't as high, but it was still profitable. Okay, again, there's not going to be a guarantee that when you use it for a substitution that it's going to work out. But what typically can happen is instead of trading by the way, if the security went down instead of up, this still could have made money. That's one of the beauties of the spread trade. It can make money no matter which direction the overall market goes. The typical hold times for these types of trades are anywhere from a couple of days to a few weeks. So what I typically do in the Wealth with Spreads program that I'd like to invite you to join, the way it works is I'll go to the market or the document here and show you. We have the Wealth with Spreads program. And every week, well, first, actually, before I get there, if you want to learn more about spread trading, there are educational videos on spread trading and how to do it, targeting, finding zones, using the spreads itself, and even working with brokerages and opening up the right kind of accounts. Once you learn that information, every week I put out a video on trade ideas. So I'm not going to give you the current one, sorry. But what I can do is go back here a little bit. Let me see. Where the heck is it? There it is. And we get to, whoa, starting to lose power here. Hopefully I'm still online. There we are, Wealth with Spreads. Now let's pull up a spread ideas for, let's see, we got March 21st this year. I usually put out anywhere from a minimum of 5, sometimes 8 trade ideas a week. And so what I do is I put out that video, and in the video, I go over this document. And I even give you a copy of the document so you can have it as well every week. And this was March 21st through 26th. So what happened was in this case, come on, oh, too far. It's a PDF document. Here were the trade ideas just for that week, March 21st through March 26th. And you can see there were quite a few ideas this week. So 1, 2, 3, 4, 5, 6, 7, 8, 9 ideas just that week alone. And I give you the direction, either long or short, the time frame we're trading on. Most of these are going to be longer than 60 minutes. On average, I'm usually looking at daily and weekly charts, looking at bigger pictures, sometimes 240-minute charts. 60s are kind of rare, to be honest with you. And what we do is I give you the trade information, where to get in, either by date or by a zone, how much risk we're going to take, so you know that ahead of time. Just because we put up margin of $825, we only risked $100 of that margin. And you can see the margins are greatly reduced. These are overnight trades, by the way. When you start trading futures, one of the big drawbacks is the margin. No, it doesn't show closed P&L, but I'll show you that too. I have it. I track everything. So for instance, if you want to trade the NASDAQ overnight, watch this. NQZ21. There's the NASDAQ. Right now, the initial margin, as you can see, I'll zoom in so you can see it better. The margin for the NASDAQ for one contract is $18,700 overnight. But what if we trade it as a spread? Introduce the NASDAQ H22, and you buy one and short the other. Look where the margin went to, $2,500, and that's overnight. So that's pretty awesome that you can get those kind of opportunities with a lot less margin being put up. So anyway, getting back to this trade idea page, well, not only do I give the trade idea, but then I discuss it. I go through and show you what the trade looks like and how to trade it in the platform. This was set up a little bit differently. Sorry. Let me get a better view. I am pretty detailed. I like to think that. Let me go to a more recent one here. And well, because trading spreads can be a little difficult. You saw how long it took me to bring up that example. I want to make sure that you understand how to do it properly. So if I look at a more recent idea here, what's it showing there? 2021, there we go. Just trying to find a more recent Wealth with Spreads video. There we go. We'll go to the one from my birthday week, August 8th. I'll show you that. So again, you get this video that basically I go over each one of these trades. There is automation available. You can set up automation in a lot of these trades. Again, I give you the trade ideas. We also do intermarket spread. So right here, this one's intermarket, meaning we're doing the same security on both sides, live cattle. The crude oil was intermarket. It was crude oil versus crude oil. But we can also do trades like this, gold versus platinum. And in gold versus platinum, you're doing intermarket spreads. They're a little bit trickier, but they're easy enough to do. And you can set up the orders ahead of time on most intramarket spreads. So what I did in these videos and also in the document was right here, I go over the trade idea and why I picked it. This one was actually one I get from a service that I use, but I fine tune the entries. We don't just randomly enter on those dates. I look at the average moves over the last 15 and 30 years, or actually this is 5 and 15 years. So that's the current spread chart. That's the average over time. I look at it from different sources, and you can see over the last 5 and 15 years, this was a very profitable trade idea between those dates. Now, it doesn't guarantee it's going to happen again, but I look for trades that typically move that way 13 or 14 times in the last 15 years. Then I chart it to give you an idea of exactly where to get in. So right here, we've got that area of demand that we're going to identify, and we're going to buy on that demand zone, not just at the date, but in a specific area where to buy so we can limit our risk. And I talk a little bit more about the trade itself. It's not showing on here, but I also usually show how to put in the trade in the trading platform as well. And I do that on all the different trades. And as I was mentioning, I do track all of the trades. So let's see, do I have, well, this one's one from August loading up. There it is. So looking at August, all the trades are listed. Every single one that I showed to the students gets shown here. And I'm going to zoom in a little more so we see that bigger. There we go. And for instance, I'm sorry, this is May. So you see right here in May, you've got the trade idea, the entry, stop, target, and this one was no entry. The reason why it was no entry, it hit the target before it got to the entry. Okay, that's fine. Some of them, obviously, we get into the trade. You can see there's the entry price, stop, exit price, and how we did. This one was a break even because it had a trailing stop. This one was a win. We manually exited because of the end of the seasonal move. Remember, it has seasonal entries and seasonal exits. So the other nice thing about this is when you go into this program, if you decide you want to join this program, you get all that information right here. The other thing you'll see is it says SMS opt-in. What I do is I put out SMS alerts when trades are either hitting targets. Actually, I can show you the last 20 SMSs right here. Right here. NGH22, NGJ22. That's a trade we're looking at right now that we're in. Short from 1010, move trailing stop to 1.255 to protect the profits. Or this one, we were looking at this Australian dollar versus the Swiss franc. This is very similar to a Forex trade, but by using spreads, it doesn't matter if they both move up or both move down. We're taking advantage of the price difference between the two. So this one, again, we were taking some partial profits because we hit target and we're moving our stop. I think I actually have those charts open. Yeah, I do. So let's see, the Australian dollar and the Swiss franc. There it is right here. So that's an active. Oh, we just got the stop out, so I got to put out the SMS for that. You can see that the entry price was right here. We got in based on the seasonal date, and we ended up hitting target number 1. So we made a full target on that one. Let's see. Oh, actually, wait a minute. We'll do it this way. Here's the October tracking sheet. October's been killing it. So you look for, there it is. Australian dollar. Nope, that's not it. That's the Australian dollar versus Japanese yen. Where's the Aussie Swiss? That might have been September. Yeah. Sorry, that's on September's tracking sheet. You can see this month, actually, we haven't had a single loss yet. Oh, no, we did. There's one. We had a loss there. Now, in order to do this, you obviously have to have enough money for all those trades and keep them open at the same time. The majority of the margins are relatively small. You see $110, $825, but every now and then they get big. 8,000. I say big, but they're still small in comparison to overnight trading for directional futures. Actually, that $9,000 is the biggest margin right there. So in order to do every single one of the trades, now not all of them are open at the same time. You see some do overlap, but many of them are exiting before others are entered. So on average, you're probably looking at about $20,000 to $25,000 to do pretty much every single one of these. 50,000 would easily do it. Do you have to take every trade? The answer obviously is no. But if you did, then you could possibly replicate the results. And this is a simulated account. But again, getting back to what the spreads are all about. What was I here? There we go. What happens with these spreads is they can be seasonal. And we can even use this for the broad markets. If we were to take a look right now, one of the things I look for when it comes to my charting is here are the 4 US equity futures. Let's go out to a daily time frame. And why is that not on? That should be on a percent change. Let's see. Oh, I think I've got to go over here for it. There it is, percent change. That's what I wanted. Anyway, if we look at the most recent rally started in the beginning of October here on the 4th. And one of the things you can do, again, if you understand how the markets relate to each other, is figure out who's lagging and who's leading. So if we go back again to about the 6th, right there, started that rally up, you can see that the Russell 2000, that's the green one, is, and the labels are over here. Again, I'm going to enlarge those. I apologize. I don't know why it's shrunk down on me. But, yeah, where is it? Parents. There you go. Now you see labels. So you can see that the Russell was leading. Meanwhile, it looks like the NASDAQ was lagging quite a bit when they were trying to move up. So if you caught that in time, let's say you noticed that was separating right here, perhaps on the 13th of October, you could have created a spread trading the Russell versus the NASDAQ. Since the Russell was strongest, that would rally faster. You would buy the Russell. At the same time, you'd short the NASDAQ. You're going to lose on the NASDAQ short, but you'll make more on the Russell gain. And that's how a spread works. So if I chart those two separately first, just show you, we do RTYZ 2021. And we go, yeah, we're on daily chart. So we go to the October session I was just talking about. And as mentioned, we kind of bottomed out here on the 6th. There it is. And we were recognizing this on the 13th. So right there, what we're going to do on that 13th, as I mentioned, is buy the Russell, but short the NASDAQ at the same time. So if I bring in the NASDAQ, there it is. Thicken the line a little bit here. You can see the bottom there. Oh, come on. That's what I needed. So percent change chart, again, I got to zero them out in the same spot. There it is on the 6th. And what you can see is they separated. Actually, this one went the other way. They overtook. So if we're getting in on the 13th, what we're going to be doing is buying one and selling the other. So what we would look for is, again, there's a little more work for this, but what I can easily do is chart the two. So I'm going to go back to candlestick chart here, and I'm going to bring in NQZ 2021, oops, minus RTYZ 2021. Now, that's one way of looking at it, but this is not the right way. When you look at spreads, there's actually something else you got to do in addition to this. You have to zero them out, so to speak, to make them equal, because the tick value of the Russell and the tick value of the NASDAQ are not the same. So there's a couple of extra steps, plus the way they move the volatility, you actually have to make adjustments for that as well. So I'm going to multiply by the point value here and multiply by the point value here. If you don't fully understand this, don't worry. And I also need to do 2 times RTY and see if that works. Nope, hang on. There we go. That should work. And now what we can do is look to see, again, on August 6th, we could have done this as the other way around with the Russell first as well. But let me go to August 6th and see what's going on with the chart. So there we are, August 6th. And that's what the chart looks like for this particular security. It looks as though we were near an area of demand right here. And we overshot it a little bit, so maybe created a new area of demand going on here. Overall, the trend was moving a bit to the downside, but I cannot sell the NASDAQ right now. And the reason why I can't sell the NASDAQ is we're not at an area of supply. So what I would need to do in order to trade this is actually go long. So just because, there we go, get the name out of the way. Just because I see that, hey, you know what, I think the NASDAQ was lagging the Russell, I think it's going to go bigger. But what I'm going to do instead is, if I'm going to short, I'm going to short it at supply. But we're not there yet, which means we're probably going to rally till we get to the supply zone. So I see, wait a minute, this is actually making a little bit of a demand. So on the 13th, when I see them separating from each other, I can now wait for us to come back to demand and buy the demand zone, sell the supply. That's it. So there's the entry. 13th, there it is. 13th of July, you get it. I'm sorry, October, I can't say. 13th of October, we would buy the spread. Again, I would not be shorting this, even though I know that the Russell was leading, because the spread chart is telling me something different. It's telling me it's going to go up. And sure enough, there it is. Now, the beauty of this is, again, oops, sorry. Let's see, stop. The beauty of this is, once again, the NASDAQ normally costs you $17,000, $18,000 to hold overnight. And even though we're trading 2 Russell contracts in one NASDAQ, let me show you, it's a lot cheaper. So the entire position for an overnight trading would be $9,900. That's a heck of a lot cheaper than even one NASDAQ trade holding overnight. And the beauty of doing this, again, not only do you have this lower margin requirement, but let's see what the profit was. It said it was 9,900, sorry, 9,900. And the rate of return on this is simply the price difference between these two. Yeah, get that out of the way, come on. Oh. So what we had going on here was, again, 80,445 minus entry was 755. We actually made $9,600 on $9,000 investment. That's 100% rate of return right there, just based on the opportunity. And the nice thing is, there's a lot of tools that are out there that can help you with identifying the spread opportunities. I actually put the videos together today. It's Friday. Every Friday I put together the videos. That particular trade would have been entering on the 13th. I got 1, 2, 3, 4, 5 days. 5 days, double your money. You know, that's the nice thing. I track all that as well. I was saying right here, we look at this October schedule. And for instance, the very first trade was when that was trading notes and bonds. So it was the knob trade, we call it, notes over bonds. Let me just zoom this a little bit as well. Light it won't pop out. So yeah, I can use the Omega charts linked in with the Trade Pro Trinity to do the spreads. There's a lot of different sources and tools out there. But right here, you can see that we got notes and bonds. And I was basically buying the notes, selling the bonds. That's a long trade on a 4-hour chart, getting in on October 3rd or the zone that I identified. And I got my stop loss either based on the time. Hope you can hear the thunder. It's great. Pouring down rain too. Anyway, or the zone. And my target's either the date or the zone. Margin was $2,800. Entry date, exit date, the win. And right there, I tracked the percentage, the rate of return. And the reason why we got out was target number 1 was hit. That's it. If there's multiple targets, typically I have multiple entries there. So there it was. Target number 2 was right here, same position, but with the second contract, I do 1 contract per target. And you see the exit date was a little bit later. The entry was the same on the 3rd, but we got out a week later here on the 13th, and we didn't get as much because it was a trailing stop. But I track every single one of those to get you the highest probability for entries and exits. We've been doing really, really well. There hasn't been a single month that was a losing month. As a matter of fact, actually, I get to brag a little bit here. I bring up right here all these trade records. This is current month. This is unusual. I'm having a pretty amazing month. So looking at a $25,000 account, you can see the rate of return on that $25,000 account. We had 14 wins, 1 loser, 2 no entries so far. Had a lot of good trades obviously identified. And here's a key thing too. Look at the average win versus the average loss. It's much bigger for the average win. Then you go to last month, September. This is more normal. Okay. What we're doing this month is not normal, but I'll take it. I'm happy. Again, you can see 9 wins, 2 losses. So we have a good ratio there. And I maintain higher average wins and average losses. It wasn't quite as good as I'd like, but it's still pretty good. And the average rate of return per trade. Okay. Average, maybe. Actually, we'll take a look and see. This actually, August was pretty good. August was 29,000 for the return. And again, you had 12 wins, 5 losses. So 44% of my trades were winners. Pretty good ratio. And again, look at the ratio, 2,400 for the wins on average, only $400 for the losses on average. July, again, went back down to a little over 10 grand. So you've got 1,038 for the win, 3-to-1 reward to risk right there. And there I had a lot more winners as well, 13 winners. You go to June, and I've got records of each one of these. This is interesting. I had a bad June. This is what a bad month looks like. 8 wins, 8 losses. So I was equal there. But again, I still had more size on the wins than I did on the losses. So even though it was only 50% for the actual trades taken, I came out profitable. So that's the key thing. If you keep the loser small, you can still be profitable, even if you win and lose the exact same amount. And not every trade is going to be the same size, but the law of averages works out that way, that if you maintain smaller risk, you could still have a profit, even if you have the same number of wins and losses. So that was my weakest month, I think, for this year. Again, on May, we had a pretty good month. This is set up more for swing trade and retirement. This is not to be done for day trading. These swing trades, on average, take several days. Again, going back to this month, you can see that there was an entry on the 3rd, out 3 days later, or out 10 days later. 4th through the 11th, that was 7 days. This one was an entry on the 4th. We still have a trailing stop open on it right now. And here we are on the 22nd, we're still in. Another one in on the 5th, out on the 10th. So many of them are designed to be anywhere from several days to a little over a week long. And then we get those occasional runners that are going to be going for several months. And that's fine. As long as he's paying us, it doesn't matter. So again, just looking at all these, April was 4,000. So that brings down the average a little bit. But overall, this one was interesting. Look at that, 9 winners, 10 losers. I had more losers than I had winners. So I was only right 47% of the time on the trades I took. And yet I'm profitable because, once again, you can see the average loss is much smaller than the average win. So February, and then the beginning of the year, there you go. So yeah, I think it's somewhere around 10 grand for the average, maybe a little bit higher. I haven't averaged it out. I did look and see. Oh, no, I'm sorry. Average month year to date is 134,000. So 13,455 average month. And the rate of return, if you had a $50,000 account, was 269%. That's just to this point in the year. So spread trades can be very, very good if done properly. I've been able to identify great opportunities. And again, I send out SMSs when the trades are coming into play. And it all comes down to understanding, where did I go here? I wanted to go to, there we go, season algo. Understanding how to find the right opportunities. And I take a lot of the guesswork out of it for you. Yeah, the 13,000 average was on about a $25,000 to $30,000 account size. That's what it is. So again, if I was looking for something like the NASDAQ versus the Russell, NQZ 2021 minus RTYZ 2021. And we're going to do interactive. Actually, I have to do that again, unfortunately. And before going further, I'm going to make an adjustment here. Do a conversion. Oh, it did this way, didn't it? Okay, I get to practice. 1, version 20. Add. RTYZ 2021. We're going to sell 2 of those. That's 50. Apply and build. So what this is now doing, I won't let me find it. Oh, that's why. Keep forgetting different platforms you use different things. Let's try with just the one for now. I'll fix it in a moment. Are you kidding me? All right, we'll do it this way. I swear I know how to use this platform. I use it every week. RTYZ, can't find it. Doesn't like the Russell for some reason. It can't find it. Maybe uses a different symbol. There. It's using, nope, that's 10-year. Oh, well, I'll figure it out later. We'll do something different here. Instead, we can do NQZ21. I don't want to waste too much time on this like I already have. And the multiplier, one contract, again, conversion, 20. And we could do the Dow with it. That'll be easy enough. And with the Dow, we're just using 1-to-1 contracts, and we have a multiplier 5 on that. So apply and build. And this is what I'm looking for is what is the average move? I can even put it in the 30 years as well. So this tells me what the average price movement is for that particular spread. I can zoom in on this, and we'll go in the past first. Oh, it only give me 5 and 15 years, and then give me 30. That's okay. Try 20 as well, maybe. See if it shows up. Yeah, there it is. So what I'm looking at is this spread. The black line is the current spread price. Again, it's just the NASDAQ and the Dow on the spread. The red line is the average price over the last 5 years. The blue is the last 15 years, and the orange or yellowish is the last 20 years. So what I can do then is see where's there normally a period that prices move very well for me in my favor, and it's coming up. So here's a spread idea I can set up in the future where we can see right here, we normally get a rise right around November 2nd through the 7th. So let's say we want to buy November 2nd. I said through the 7th. It's all right. Yeah. So let's build that. And right there, now I've isolated a point in time where typically you see the last 20 years was a big rally. Last 15 years was still a rally. Even the last 5 years, we had a rally out of this. So what I can do now is set up an order to buy on November 2nd, let it go with a stop loss and exit if I hit some targets or exit on the 7th. And yes, you can automate a lot of this. It's mostly set and forget. You do not want to watch the screen with these. These are always, for the most part, spread trades are things that you let go and not worry about watching them. So if we did this before, let's go back in history here and see if there was another spot that we could have identified as a buy opportunity. And there is. So right here, theoretically, you can see there's normally a rally from 12th of October. Let's see, where's it end? The 5 year starts to drop here, though. Let's see if I can find a better. So you take out the current price. And we're just going to look at the last 5. There we go. Last 5 and 15 years. Just find an area where prices spiked. I mean, we got that spike right here. Seasonality is great for grains. It's actually better for grains than it is on other things typically. So I was just trying to find an example. As a matter of fact, let me just look for a grain instead. We can look at ZCZ21. And I can do a corn calendar spread. So let's see what do we have here. Yeah, it's already pre-built. Build. And right now, this is corn intra-market spread, which is actually really cheap to trade. And it looks as though we got a little bit of a drop coming here pretty soon from October 28th to November 11th. So if I build that, what you'll see is right here, typically between those dates, now it's not the biggest drop, there's better ones out there, but historically, between those two dates, you see the markets tend to go down. Over the last 5, 15, 20, even 30 years, it's been a profitable drop. So what I could do is set up that trade to sell. And in this case, I'd be selling December, buying the March contract. Well, let's test that theory. If I go back in time, it's easy to see with the current month, but let's go back and see. Oh, wait a minute. What do we have here? Just the wrong way. Let me go that way. Here's another period of time right there. So we bottomed out October 3rd to the 15th or 14th. We'll do that one. October 3rd through the 14th. Oops. Show you what I'm doing here. Okay. October 3rd through the 14th, I'm going to take out the current price. But the historical move, as you can see, and there's no guarantee it's going to happen, but right here you can see historically, if we look at the last 5 years, if you bought that spread on the 3rd and got out on the 14th, you made money for the most part every year. If you did the last 15 years, it also made money. The last 20 years, it made money. The last 30 years, it made money. So for the last 5 to 30 years, on average, if you bought this spread on October 3rd and got out on the 14th, you made money. That means there's a high probability that's likely to happen again. Commodities, especially anything that's grown or extracted from the ground, is very seasonal. And what happens is it tends to move in the same direction year after year around the same time. So if you can find something predictable like that, you're able to do these spreads. And the nice thing about the corn trade is it's very cheap to put on. So I can also put in very little margin and have very low risk if I choose. So for instance, if I do ZCZ21 corn futures, one contract overnight is normally $1,678. That's a lot of thunder. So $1,678. If I add in that March contract, ZCH21, oops, what happened there? ZCH21. I keep doing that. Enter. No. Oh, 22. That's why I can't do 21. Dummy. Okay. Anyway, so there, I'm going to short that one. Look what we did. We knocked that down to $660. So for $660, you can have an overnight position in corn for as long as you want. And in this case, historically, it's a high probability trade. No guarantee it'll always work, but what we can do then is chart that. So this was corn and corn, ZC. I'm just going to do it on TradingView to make it easy for me right now. ZCZ 2021 minus ZCH 2022. And there's the spread chart coming up. Hopefully my internet's still running here. I've got some power outages going on in the area. And this is running slow. There it goes. Okay. So again, during that time of year, it was October 2nd. It looks like this one didn't work this year. And what I can do is take a look to see, would this have been a good opportunity? So here we are on October 2nd. And remember, historically, this usually goes up from here. But what is my overall trend? My overall trend right now is down, and it looks pretty strong. That's why I use the RSI to help me out as well. So by looking at this, you can see right now we're below 40, popping below 40 on the RSI. That means we got too much bearish momentum. This is not something we want to buy. And sure enough, you can see it went down, tried to pop up on the 15th. You would have been about flat. It would have been a good trade though. But by using the knowledge of the normal seasonal moves, in addition to being able to find where to buy and where to sell based on supply and demand, that allows me to find these high probability opportunities. So that's what I offer when it comes to the Wealth and Spreads program. So as I was mentioning, if you're interested in joining me, there's a link that's in the chat, or they're going to put it in there again, where you can join the program. And basically, like I said before, this is something that a lot of people do in trading. It's actually something that big institutions do as well. I'll show you real quick here. I can get this open. Fractions are a margin of the cost, for one. I mentioned before, if you try to hold overnight, these are older margin prices, but you can see the discount you get with the margins doing spreads, so much cheaper. So you get the trade using a lot less capital. That means you could put on more positions or just simply trade with less risk. The risk is reduced because, again, if you put in a stop loss on a directional trade, in this case, they were risking about $640 to buy futures for crude oil. Doing the same trade as a spread trade, though, in this case, they were doing January-May crude oil spread. They placed the stop loss down below, and they had less risk, 120 bucks. So you can reduce risk and get greater probabilities. Remember, if you buy a security, you only make money if it goes in one direction, the direction you purchased, or if it's shorts, it has to go down. In future spreads, you make money if the market goes up because that's where the spread widens. But you can also make money if the markets both go down because the spread widens. Or if the market goes sideways, but the spread widens, again, you still profit. So there are more ways of making money when it comes to a spread than with directional trading. And one last thing is professionals are doing it. This is what's called the Commitment of Traders Report. And this is from July, but it doesn't really matter. I can bring up a new one and it'll look the same. This is showing all the futures trading on wheat. And just as a quick example, there were 348,000 contracts open that week. Out of that, the non-reportables, those are the novices like us, we didn't do a lot of the trading. Most of the trading was done, as you can see, through professionals, either what we call reportables, which are the big brokerages, or the producers or users of those securities. But the interesting thing is when it comes to reportables, those are the big brokers. Look how much spreading they were doing. This is not a small thing that's being done every once in a while. The pros do a lot of spreading. As a matter of fact, over a quarter of all the trading going on in wheat is being done by spread trading. So this is a pretty big thing when it comes to the markets. A lot of spread trading is going on. As I mentioned before, if you've got a challenge with the account size and you want to be able to hold futures overnight, many times you just can't, or you're forced to trade micros, which is fine. You probably should do something like that when you have a smaller account. But if you have the ability to trade spreads, some of the intramarket spreads are as cheap as 50 bucks. I mean, I was talking about the margins on a micro contract. Check this out. Let's see if I can find it on here. Zoom in so we see it better. If you do, for instance, MNQ Z 2021, the overnight margin is $1,870. But if I do MNQ H22, this is now a spread. If I sell the other contract, and what did my margin go to? From 1,800 bucks, I can hold the NASDAQ overnight for $253. It's pretty amazing. So now my risk will be reduced as well. But you can trade micros as a spread rather than just micros as standalone. You can do this with currencies. I haven't looked at the margins on that. If we do, let's see, oops, let that go here. 6E, let's do, and we'll do H22 Euro futures, and I'll do 6E M22 June. And overnight, that's 82 bucks. By the way, that is the free, I'm sorry, not free, sorry, it was real data. Yeah, this is real data. So anyway, this is if you trade the euro overnight, normally for one contract, it's $2,400 to hold overnight. That's not even the micro. This is the normal contract, the full size euro. You can hold it overnight for 82 bucks as a spread. That's pretty crazy. So you can make trades for less than 100 bucks on the full size. Now, if I did this as the micro, it'd be even cheaper. So that's kind of nice. If you happen to be challenged when it comes to your account size, this is definitely an easier way to go for overnight trading. And it works very similar. This is the NASDAQ 100 holding overnight, long entry, and a nice little return. If you did as a spread, again, the margin's reduced. You went from $17,600 margin to 1,200 bucks for margin. Better opportunities. The spread, in this case, even had less risk and a better rate of return. So that's why I love trading spreads, especially for swing trading, because you're taking either the directional risk out or you're reducing your risk altogether, and you have better opportunities. If you don't have a lot of time, this is not a day trading type of strategy. This is designed for you to do longer term swing trades. And the smallest time frame you look at is 60 minutes. Most of the trades, you set them and let them go. You can set up, especially if you have the right software. I'll show you here on Trade Pro Trinity, for instance. If I want to trade, what do we have here? This is copper that I just loaded up. And in copper right now, I've got February 2022 versus March 2022. If I decide I want to trade a spread and I want to go long on the spread, look at this. I can do sell limit, sell stop, good till cancel. Now I can get in right now for a spread and it'll give me my target and my stop loss, good till cancel. And what do I do now? Whatever I want. The trade is taken care of. The only thing I might have to do is when I receive an SMS from my instructor, I might have to move my stop loss. That's easy. You just log in and adjust it. So it's kind of neat that you don't have to babysit your positions and you get less risk. Here's a position I've had on for a while. I forgot all about it, actually. This is for June of 2022. This is lean hogs versus live cattle. I shorted one, bought the other because I'm trading the price difference between the two. So right now I've got negative $300 on one, but positive 980 on the other. It means I'm up $680 net. So that one's working out pretty well. And that's all it is, trading one versus the other, one against the other. So spreads help to, get in with less money. And this was just showing you a couple of trades I was looking at. Don't need to go into that. If you don't know where to learn how to do this, again, join the Wealth with Spreads program. The link is in your chat. And what we do is we have on-demand reviewable education. I showed you before, if you go into the program, for the education we have right here, it's all on demand. You learn from those videos, and we do live sessions, usually once every other month, where there's an open Q&A. At any time, if you run into questions, it's real simple. All you have to do is ask. Down at the bottom of the page right here, when you log in the member section, just send me a message. And I respond usually within 24 hours. So it goes directly to me and lets me know, hey, I've got a problem with this particular trade. I'm not quite sure what you meant here. The videos you receive are very, very detailed. They usually are about 30 minutes long, and they come out on Saturday afternoon. The nice thing is the market doesn't open until Sunday afternoon. So you got plenty of time. Like I said, I'm going to be putting the video together today. I recorded on Friday. It gets put out on Saturday. So you can have all day Saturday and Sunday to review it before the trades become active. And some of them get triggered on Sunday night. Many of them don't get triggered till later during the week. And you can review the video as many times as you want, as well as the PDF of the video. And I think there's some documents that support, there it is, trade results. Got the last couple of months of trade results there as well, that spreadsheet I was showing you. Students have access to all that. I'm very transparent when it comes to what we do here at the Wealth with Spreads. So if you're interested in joining, like I said, you got the live Q&A sessions. We do some bonus training sessions. We have the supporting documentation to help you. You can click on the link, and I already went through all this. I'm not going to show you those again. It's the same ones you saw. There's a lot of stuff there. It's a pretty good package. You're getting the self-paced lessons so you can learn more in depth about how the spread trades work and take advantage of those. In addition, I talk about supply and demand and how to identify where to buy and where to sell on individual charts. You get the weekly video with the trade ideas. You get the real-time alerts throughout the week. Whenever prices come into entries, I send down the SMS alert to let you know you either need to adjust a trade or trigger a stop. Many of the trades have already been triggered because you can set up the trades ahead of time. I even have videos on how to do the order routing and charting in the different spread package software that we use, either the Omega charts or using the Thinkorswim. You can do it there, or even Trade Pro Trinity. So all of that is available to you. Anyway, if you're looking for it right now, what we also do is two different types of subscriptions. We do a monthly subscription. Normally that was $4.95. We're knocking that down to $2.95 so you can subscribe, and it's renewable automatically at that same price every month. And we're not going to raise the price on you. You're locked in as long as you keep your subscription active. Quarterly, we give you a little bit of a discount. We've knocked it down $500 from the retail price to $695. If you decide you want to do a quarterly subscription, we're not going to lock you in for 3 months right away. We're going to give you a chance to try it out. If you subscribe by clicking that link and go to the quarterly subscription, as I was mentioning, I'll click on the link myself just to show you what it looks like. Maybe, there it is, popping up. And when you look at this page, you'll see, I'm not wearing the bow tie today, but right there is the 2 registrations. And if you go to the $695 registration, you will put in your information and your subscription starts right away. You'll be able to get the video tomorrow. You'll be able to review the previous video already. And what will happen is your card will not get charged for 2 weeks. So you'll actually get 2 weeks of this information available to you for free. If you cancel before the 2 weeks, we never charge your card. So you don't have to worry about chargebacks or refunds. We don't deal with that, okay? Once the 2 weeks is up, your card will be charged though for the full $6.95, and then it just auto renews every quarter until you decide you want to cancel. And then it would just go ahead and run out the end of that, and then you wouldn't get charged again. So we're pretty open, pretty easy to work with. If you got any questions, like I said, I'll be more than happy to answer those for you. Love to have you in the program. Trading spreads is something that is often overlooked when it comes to making money in the markets. And honestly, it's one of the best ways. As you saw, the pros love to do it as well. Why not try it yourself? I'll actually go to my live charts here. Like I said, we got this one was triggered for a stop. So I got to put out the SMS now on the final. It probably already went out actually. So I got to check to see if there's any others I need to look at. What else do we have here? Ooh, that one jumped. That one actually hit. This one is on the trail stop right now. This is another one. We entered back here. This is lean hogs, April versus August. So this was an actual trade. We had $300 of risk here, and the first target was already hit for $1,130. You see, that was my first target. That's where the trailing stop is right now, 6.975, and we've already surpassed our target. So right now, we're just holding on to get extra profits with a trail stop. So we're actually going to have the move to trail stop down today because I usually use these moving averages as a trailing stop. And we've got right now 7.125. So I could put the stop at 7.10. So I'll send up that SMS alert, but this is kind of what we do. I identify those opportunities, and as they hit those areas, if it hits the stop, it's going to trigger an alert and let me know. So this SMS will go out as well. Nat gas, that's another one we're waiting on. This one's a tricky one. As you can see, it's going back and forth and back and forth. I think I canceled that because of the movement. Soybeans, another trade that we're sitting in right now. This one has not hit entry. You can see that from the time I put it out last week, it's just gone sideways. There's no value in wasting money. So I'm waiting for prices to come into a supply zone before we move down to our 3 targets here. If it ends up moving in, great. If it goes down and hits the target first, I'll cancel the trade. Or if it just goes sideways for a while, I'll cancel the trade. We don't need to sit and wait for it. But that's what we do, is look for the right opportunities. With this one, I'll usually cancel it probably another week or two if it continues to go sideways. Just give it a little time. I usually will definitely cancel if it hits this first Fibonacci target before it goes to the entry, or if I see the trends are changing. So there's several different reasons, and all that's detailed too in the documentation. If you go back to the Wealth with Spreads program, there's documents and videos that talk about a lot of those things. So I want to thank everybody for being here. Hopefully I will see you in the Wealth with Spreads program. If you got any questions, please let me know. Well, thank you, Will. And thank you, Kevin. Thanks everybody for being here. Yeah, like I said, I'm going to start doing searches now. So I got my season algo. Where did I have that opened up? Where did I put it? There it is. So I got to go through now and find the trades I'm going to be putting out for this week. So a little bit of work for me to do. Now, maybe I'll have some lunch first. I'm kind of hungry. So you guys have a great weekend. Take care, trade safe, and trade well. Hopefully, like I said, I'll see you soon. The link is there. If you got more questions, let me know. And that's it.